So Ben Peters, in fund management, a lot of people talk about quality and growth in kind of interchangeable manners. There is a difference. Can you tell us a bit more about that? How you recognize that difference?
Well, absolutely. And if you put in the value piece, you've got the three kind of legs of the stool that define any investment, whichever your style. So I think that growth is helpful. It's much easier to be a quality business if you're in a growing industry. So declining businesses is difficult. You tend to have declining returns on capital. And actually, if you look, if you do market studies, companies with declining return on capital tend to underperform pretty materially. But there is a difference, a subtle but important difference between quality and growth, because a company can grow without ever making a profit if it simply invests all of its cash flow into capital expenditure that then depreciates, and it does that forever. That business is worth nothing. It could be the biggest business in the world. Most businesses do reach a scale where they create some profitability, but that's just a hypothetical. So, and then you have a sort of degrees in between, very, very asset-light businesses where competition is probably quite fierce because who wouldn't want those economics? And then there's probably a sweet spot and this is where we come in, where you have companies that are growing. Doesn't have to be really high growth, but they are able to reinvest in themselves at a very high rate of return. And that's, they're classically called compounding businesses. And they are usually growing businesses, but aren't often, they can be, but aren't often high growth businesses. That's a different thing. So it's a subtle but important difference, because what we want to capture is the economics of that compounding inside the company. And to my mind, that is why there's often an opportunity in quality businesses, because that work goes on under the surface. It's really easy to look at revenue growth. I think NVIDIA is a great, current poster child for this. Growing really fast, very exciting, new technology, and there's nothing wrong with that, by the way. It's a great business, but that's something you can get excited about. Whereas a business is growing its revenues at, say, 5 or 6%, doesn't sound that exciting. But if it's generating a 30 or 40% return on the invested capital within it, that's a very nice high rate of return inside, and it generates lots of cash flow, some of which can come back to us as shareholders. And it's that quiet kind of work of quality which I think really leads to the opportunity.
But steady and stable.
Steady, stable often, yeah, but that doesn't mean sort of no growth as well. They will, as long as they maintain their market positions and develop their products or service, whatever industry, they will grow.